क्या बात करें?
मुंबई की बारिश.
Unexpected things are happening everywhere, right? Tariffs are getting solved. The geopolitical tensions. It looks like we are at the end of the, end of this, at least this cycle.
Yeah.
Earning season is ending.
Correct.
FI selling is ending. A lot of cycles are ending. I hope the bull market cycle is not ending.
No, I think we are still in bull run. As I said long back, like easy phase of bull run is over. We are in bull run, decisive phase of bull run. Okay,
that's decisive phase of bull run.
What is difficult? Matlab, we are in decisive bull run, okay. But within that we are in difficult phase of bull run. Okay, now let's look at India first of all. So India is right now in a mild risk to, I'll not say extreme risk on, but is a risk on phase for us, and where US is risk off phase. Right from January, US came in a risk off phase. So we are in a very unique situation where if this is the background, then money will flow to India. And you have seen in last 15 trading session or 20 trading session, FI flow has been constructive. The moment US investor becomes slightly jittery about US, money will move out. And this was our thesis in 2025 that decoupling process will start. We thought maybe by July, but because I was linking with the dollar cycle peaking out and hence decoupling will start, but had already started. That process has already begun. What it means that people are looking for safety, okay, and even look at European investors, they are also pulling out from US. So US, we have seen extraordinary cross-border flows in last many years. I think that cycle has peaked out. And if we believe if 10% money shift from US to emerging market, Asia-centric emerging market, there will be tsunami out here, okay? And that's the reason in last our fact sheet we wrote is bad for India and China. Okay, it's not that bad for emerging market, it's good for India, okay. In fact, look at the beginning of the year, people were bullish on, best of the strategy was bullish on US. They have written off emerging market completely. Now, exactly reverse has started. US actually peaked out. Still, I think we have said in January that US will correct 15 to 20%, particularly NASDAQ is already corrected. I think maybe you can see small pullback rally, but I think ugly phase of next level of fall is still pending in US.
Okay. But Sandeep, why do you call India risk on? Is it purely because of the valuations, or are there other macro parameters which make you feel
so? It's a macro parameter. Okay. So like last year in July 2024, we were very early to say it's a risk off phase for India because macro based on a lot of high frequency data which we track started deteriorating. So we were very early to say that India risk off phase begins. Though market rally till September, so it's irrespective of the market, okay. But from a macro perspective, it's deteriorating. So now we are seeing that early signs of reversal. We are not saying that we are in massive risk on what happened in September 2023 last, and then we saw a big pullback rally played out. So that's not the case. Right now, see, markets are not about absolute always. It's always about relative, okay. Money always shift on a relative basis. If you find it difficult to make money in US, people will move out, and this is the phenomena. So it's not like the same FIs who were seller for last 2 years or many quarters, same institutions are buying again. So something has changed. Is India become very cheap? Answer is no. India is not that cheap. Marginally correction, okay. But what has changed? The perception about US has changed, okay, and hence they have to shift. Where they will shift? Where they see safety is better. It's not about absolute return, it's about safety first. So in this environment, safety is very much in India, okay, both from a currency perspective, macro perspective, and now given the size of the Indian institutions or the corporates which we have and the entrepreneurship drive we have. So we are in a very commanding situation. I think India was leading in every aspect. We peaked out first, we bottomed out first. And hence this rally, we will be the leader, and which is the case right now.
Okay. Then why have US markets retraced the post-tariff, sell-off? Today, major US markets, S&P, NASDAQ, Dow, all of them have pretty much retraced whatever they lost in the month of April. If the problem is in US, then why have US markets come back so smartly?
See, Nikunj, what you have to look at, if I maybe best gauge will be the VIX indicator, will give you the wall index, it spiked vertically. And whenever VIX spikes sharply, it tends to cool off before you see next level of up move again in the VIX. And that is the reason any extraordinary shorting or anything which is linked with the news flow, because why on 7th April? Because the Trump tariff drama started, okay, or most noise or narrative, whatever name you want to call it, small deviation from that, people take it positive, okay. But But if you ask me, everything is sorted out and everything is settled and world is back to normal, answer is no. So you have seen extreme reaction on one side, then we are seeing a reverse of that. May again market will correct again.
I am looking at your holdings right now, and one of your top holdings in your small cap scheme is Reliance.
Yeah.
In your large cap, it is Reliance. In mid cap, it is Reliance. Right. Then I look at the number 2 holding in all your schemes. It is Jio. Small cap, it is Jio. Mid cap, it is Jio. Large cap, it is Jio. ये क्या हो रहा है?
So I'll answer is very simple. See, when you get into a risk off phase, when I say we were early and we underperformed also, it's not like we underperformed. It's a part of a larger strategy. What you do, you move from illiquid to liquid. You move from small and mid to large, and you move from high beta to low beta. Okay. Now, in a mid cap or a small cap, you have a compulsion of maintaining certain weight. Let's say small cap, we have to maintain 65% small cap. Okay. Now, I'm not negative on small cap from a longer term perspective, but from a near term perspective, we felt, okay, or near or medium term perspective, that they have potential to underperform, and hence it makes sense to move large cap. And liquid names like some of the names
so small
you highlighted.
caps are still expensive. The risk of liquidity is still there. So you would like to have within small cap exposure to large cap.
So I think it's a balancing act. Okay, where I'm trying to balance my beta of the portfolio, I'm trying to balance liquidity, I'm also balancing my any redemption comes. So far nothing has come, but I'm saying every aspect, it has to be well. See, I always believe in our portfolio thing, liquidity is very important, that we always say liquidity is the prana. Okay, so that if you don't have that liquidity in place, so it becomes very difficult sometimes. It's a psychological discomfort, whatever reason, if you are unable to sell anything. So we as a house give a lot of importance on liquidity analytics, and when it comes to our own portfolio, we do look into that aspect also.
Sandeep, what's the one space that you're completely avoiding? And I'm just taking a cue from those Asian Paints numbers. I mean, forget about the stock price performance has been, it's pretty much hovering around its 52-week lows. But those numbers are really screaming still in a void. Is this the market to go in for bottom-up neglected stories? Maybe like paints as a segment? Because now you've got that crude reversal?
So I'm without getting into stock specific, any stock which gets into hated or neglected, then we as a house always look for buying opportunity, and maybe I'm not ruling out for the Asian Paints also. Okay, but the entire thesis right now is about, you asked me a question which is the sector which we are slightly more negative. In fact, since we turned negative on US market, particularly NASDAQ, so we are grossly underweight technology. Okay, technology, maybe we have hardly any exposure in technology. Okay, so it was an outright call on the US market. Like how September we turned bullish on China, what you'll do, you go and overweight metals. Okay, because there is no way directly I can play these markets. So indirectly we try to protect our impact for whatever reason it happens. So currently our entire focus is on domestic story. Right from January it is skewed toward domestic, and within export only generic stocks we have, because we believe irrespective of noise and irrespective of price movement of today also, we think there is no choice for you. Even for US customer also, we are like 55-60% of the generic market share we have. Is there any substitute like Bangladesh or Vietnam or any country? Answer is big no. So not much can happen there, despite the discomfort is huge right now. But I think the one area where we have comfortable earnings are there. Okay, so if you look at the earnings cycle also, we are very optimistic about the pharma as a space, generic as a space, and Indian companies are in the leadership position. So anything which is a leadership position which is growing, why we should be avoiding it? We are overweight in that.
You don't think there is a risk from tariffs, because there's been so much back and forth still
because
on
there is
pharma.
no substitute. Okay, if you have a substitute, okay, and let's say vehicle, you can defer your car purchase for 2 years. You can defer buying your garments, okay, for 6 months, but you can't defer your medicine even for 2 days. Okay, so that's a compulsion you have. So when you have a compulsion, you don't have too many choices. So if it's all about getting into that part rather than saying what Trump has a choice, hardly anything. And then our generics are 98 or maybe 78 to 98% cheaper as compared to other things. That's the way they are called generic. So if your value, if they are so attractive, low in the prices, how does matter? Even let's say they put 10 to 20% tariff, I think our companies are in the position to pass on immediately, and that impact even for US customer will be very tiny, and even distributors can absorb it. So it's a larger thesis call without getting into Trump's narrative. Trump, whatever he is doing, is actually a very smart businessman. He is doing it everything right from a longer term, from his country perspective. And the way people react, he is stupid. No, he is very well calculated. Okay, everything. Sometimes he act like a stupid, but he is look at smartly. He has implemented 10% tariff, and nobody has made noise. Everything is 10%. Car, auto is 25, metal is 25%. So 10% anyway, global market has accepted it.
Yeah.
We are actually funding them.
Yeah.
Right. You spoke about metals. There was a time when you were bullish on
Yeah.
metals. Right? Correct me if I'm wrong.
Yes.
Also, especially when you talk about metals, you were bullish on precious metals as well.
Yeah.
What's your take now on the metals? How are you seeing it in the global scenario?
Precious metal, we are actually quite bearish right now. When I say bearish, only from a near-term perspective. We think that 3450, 3500 area, gold has peaked out, both from near-term and medium-term perspective. But we are structurally bullish from a longer-term perspective. Somebody says that 5-year, 10-year perspective. I think one should have a very sizable bullion exposure in their portfolio. So we are very constructive. The challenge is that on immediately what you do, so we can't hedge much because none of the custodians are ready for hedging. What we have done, we have moved out from gold and shifted to silver. So we have to maintain 10% exposure in multi-asset. So we are running with minimum 10% right now. And instead of gold, we are running with silver. We think silver has better potential. That's the way, in a very dynamic manner, we are managing it.
Okay, you got approval for a new scheme in which you can go short on.
Yeah, it's not a scheme, it's a separate license known as the SIF. Specialized investment funds.
What is that?
So SEBI has recently come out of the circular on SIF. Basically, as a mutual fund, we get a new category where I can have a long short strategies. Okay, like in mutual fund, we can only hedge and we can only do true hedging. Same stock I have to short, or maybe hedging through options route or through futures route, but only in the indices. Okay, but in this case, like SEBI has allowed us to have a short position of 25%. So its starting point is 25%.
You can go short.
Yes, so we
Where
can
will
run
you go
long short strategy. Let's say we are running long short strategy on equity product. So for whatever reason, let's say we don't like, let's say Infosys, we are long and short TCS, we can do that, which is not the case in current mutual fund. Okay. So from a risk perspective, it's a great product. Okay, though generally perceived as a high risk thing, but I think it's a specialized product, more meant from institutional type of investor who have institutional mindset, who are more financially literate about this product. Actually reduces the risk because in the bull market this strategy will underperform, but in normal environment is a great
so
risk
let's
mitigation
say if you raise money tomorrow,
yeah,
how will you construct that fund? Where will you go long? Where would you go short?
Let the final approval comes for the scheme specific thing we can talk about.
But compliances you
We're
can't
just helping you with your homework before the approval comes.
So what we look at, let's say today, if I let's say today's context, okay, and I will like to, let's say, maintain my long exposure toward domestic side, okay, and some of the sector like auto where we have concern, so you can run some short position in auto as a sector, you can run some short position in IT, though it's too late right now, it's already corrected a lot, but example's sake, if let's say in January we have that aggressive view towards IT, maybe you could have run 25% short position. IT is a great, not only hedging strategy, actually reduces my risk volatility in my portfolio. It's a great product from a longer term perspective.
So where is it right now at these levels, given that IT, a large part of the correction hopefully is already behind us, where do you have that kind of conviction to go acute short?
So since we are already in a mild risk on or risk on phase in India, I'm not looking for shorting anything right now, okay? Because even IT, I'm not going to advise anybody to go short, okay? Yeah. Rather, we will look for a buying opportunity at appropriate time. Whether appropriate time has come, answer is no, but it will emerge soon. So we are waiting for that opportunity, that inflection points. As and when it happens, we should be buyer in these names.
So like Reliance, where else do you have that kind of conviction that you can buy all out right now?
So I think if I have to ask me, infra is a space, large infra space, irrespective of any government in India, irrespective of any global environment, we are investing as a country in the infrastructure space, and that is the need of the hour. So I think, and you don't have too many companies like L&T if you ask me, there is a scarcity, okay. In last many years, only limited options are left. So anything related to port, airport, infra names, EPC companies, those are the areas where we are quite bullish, and we have a very skewed structure including power. So if somebody says where is the long-term perspective, next 7-8 years, a decadal opportunity, I think power is still, whether you're talking about thermal, whether you're talking about green part of it or any other alternatives.
So you're still bullish on the Adani group?
I'm quite bullish on the group because they are in that India-centric space, okay, and irrespective of perception, since we do a lot of perception analytics, we were early in spotting that group. We believe, okay, from a cash flow perspective, they are generating, capex is in the right direction. So they will be a sizable and formidable player in this country if somebody has next 5-year vision.
You know, when the budget was announced, everyone thought, okay, tax cut, huge tax cut, 1 lakh to about 90,000 crore, and that in a sense will translate into better numbers for FMCG, low ticket items, food delivery, hotel, travel, tourism. But that trade lasted for about a month. I mean, on the budget day it started and it just fizzled out in next 2-3 weeks. What's happening to that good old consumer comeback trade after the tax cut and after the low inflation?
See, first of all, Nikhil, we have to look at this announcement. The saving just started in the April. When it started in the 1st February, when the budget came, it was just an announcement. Nobody has benefit in that sense. Now the real benefit will come over a period of 1 year. Okay, so we are only in the 3rd month of that. Okay, so it's not like only April. Okay, effectively 2nd month now. Okay, so it's just a beginning of the next financial year. And so it will be too premature to believe that numbers are there. But obviously it's a psychological thing. And FMCG, if you look at, yes, consumption theme, even we are as a house very bullish, but they're not cheap. Okay, it's not like they have become attractive from 60 multiple, now they're only trading at 20 multiples, so it's not the case. Okay, maybe from 60 has become 40 or 45, but still relatively expensive only. So I think that's the reason a lot of discomfort was there, and people last many years have not made money. So it's again a psychological thing. So I have seen nowadays, you know, any good news come, people look for a booking opportunity. Okay, okay, extraordinary good numbers, book it. Extraordinary bad, you are butchered that anyway. But even good numbers, people tend to book profit. That has been a trend because the mindset is negative. Okay, we see the background is not conducive. That's the reason we are more bullish. The behavior background is perfect. Investors.
Ulta karte ho basically.
It's not about contra call. It's a data-driven call. Okay. Now you look at where is the investor conviction? Absolutely missing. Few months back, India was buy on dips. Now it's sell on rise. Okay. Second thing, leverage position very low. Okay. MDF book hardly, not much. I'm not saying not. Retail positioning, even the mutual fund side, month on month, we are seeing some amount of disinterest coming. But the good news is FIs are back. Mutual funds are buyer, retail have lot of cash, and FIs are buying also. So one large participant who was missing for last many quarters is also back in the game. So where is the supply? There is hardly any supply. Okay, because today of this geopolitical tension or Indo-Pak tension, I think people have given up a bit. But I think in a very comfortable situation. So I think data points are more constructive right now. Okay, when everybody gives, as long the fear is there, you will make money. The moment greed comes into picture, we become cautious. So right now is the environment is fearful, and that's the way we see opportunity.
Sandeep, I want to talk about the PSU space in particular with you. It started off with the fancy and the frenzy towards just defense and railways names, and then we saw that, you know, the first signs of the sell-off in the market, which came in October, actually started with these two sectors. Where within PSUs, the entire cluster, not just defense and railways, do you find pockets of opportunity right now?
Yes. So first of all, let's understand from a larger thesis of PSU. Okay, so we were very early in spotting that thing, and we also cut down our exposure in June, July.
Yeah.
And last few months we have rebuilt our exposure. Okay, so we are added another 6-8% exposure across the board. So we are back to closer to 20% mark now.
So when you say across the board, what
across all
within
the schemes. Okay. So now in terms of PSU, so we have not added defense, we have not added railway. What we have added is large infra name, power names, oil marketing companies, okay, oil companies, okay. These are the names which are unique. We have seen some amount of hype or euphoria in, yes, in defense and railway because there were no substitute. So people, so these are the stocks we have avoided because they are, I'm not saying overowned, they are relatively overowned as compared to other PSU stock, and they are not cheap. Okay, defense stocks are definitely not cheap. Okay, because of geopolitical tension, everybody believes that this is a great opportunity, and we think opportunity is there in PSU, but not necessarily in these. That does not mean we are negative on defense. Okay, so as compared to, let's say, oil marketing companies looks more attractive. Okay, risk reward is more favorable in oil marketing company versus defense. Just for explanation's sake.
Right. I wanted to understand your take on banks, given the fact that there was a time when you all were underweight on banks. I believe you all have added some exposure to the banking
We are still
space.
grossly underowned.
You all are grossly underowned. Are you planning to change that strategy at this point in time?
No, as of now, but
You
we have
underweight banks?
yeah, we are.
You're the
underweight.
only one.
Yes.
Do you know that?
Yeah, exactly.
Do you know that?
Because over the last 1-2 months, all you've been hearing is only banks, banks and banks. That's it, isn't it?
So we have not taken a contra call because we think globally banks valuations are going to deteriorate for various reasons. Okay, we believe leverage economy as a concept will deteriorate. Okay, the way commercial bank exists today will not exist in future. The way changes are happening, so it's a P deterioration story for us. Okay, what we have substituted? We have substituted with digital. So Geo is part of that thesis. We have substituted with NBFC. So we bought many NBFC names, including the Bajaj Twins, is a publicly disclosed in our portfolio. We bought many insurance company, okay, and some sort of wealth management companies also, some AMCs also. So our portfolio, instead of having banks in our portfolio, is more towards, it's not like we are negative on BFSI, we are constructive on financial services space, but less bank. Excluding bank, we are constructive on other space.
Before we wrap, what is cheap and underowned? What is expensive and overowned?
So I think though on historical data, banks looks attractive, but they are grossly overowned by domestic as well as FIs as well as family office. Okay, and it's a P deterioration story, so we don't like it. But grossly overownership, they are no more cheap, and they are. I think growth in these names will be also limited. On any parameter you look at, it will be very difficult going forward. So that's the area which is avoid for us. Okay, I'm not saying you go short on that or maybe cut down completely. It's like we can take active management calls, so we can have a ZILS exposure, zero exposure also. Okay, but many people don't do it. So we think it should underweight in banks, but not NBFC, where interest rates coming down. Under ownership was in NBFCs. Okay. It was a hated zone because of many last few quarters concern came on NBFC. People sold off. So that's the area. Insurance is another area which is underowned. Okay, valuation wise grossly pretty attractive, I will say, and large names. Okay, so that's the area we like to participate. I said infra is the name which you like to say, power is the name which you like to participate. Power is more safe than banks.
Yeah.
Okay, because clear visibility is there. Okay, and this is the area where government focus is there. Capex will take time to come on the capacity, whatever we are doing, but it's in a very constructive space. What I will avoid is anything which in the past 2 years has been traded in the extremely over-admired territory, extraordinary hype. There are many such companies where huge hype got created.
By that logic, I should avoid your mutual fund schemes also. Last 2 year returns have been fantastic. Been admired by everybody.
But it's not. But it's not one stock, na? It's a basket of stocks. So when you're looking at basket of stock, that thesis will not work.
And avoid gold, look at silver. Opposites
yes.
happening.
Relative basis. But again, these are a lot of people get confused with our call because it's a very near-term call. If I ask me 1 quarter call, yeah, one tactical call is that we are underweight gold and we have been vocal about it. Yeah. But somebody asked me 5 years view, one should have a very sizable exposure in the bullion market.
Okay. Well,
Sandeep, I have one more question for you. But before that, I just want to quickly mark the India VIX and the markets. It's been a sudden fall that you're seeing. On the futures, we're down about almost 200 points. And you know, this move has really come in the last 15 odd minutes or so. We're not blaming it on Sandeep Tandon at all. Look at the spike on India VIX. It's up almost about 9.25%. And just a few minutes back, it was up over 11%. What's actually caving in? Pretty much all the sectors are in the red, and look at the breadth of the market. And I'm just looking at the F&O pool. It's 201 stocks which are standing to the red, with just 20 names standing to the advances right now. This is within the F&O pool. Zomato is your top loser on the index, 3.5% lower. Adani Enterprises, M&M, Tata Consumer, Hindalco, Eicher, ONGC. Sudden U-turn, given that it started off okay, and for the better part today, we've just been very, very quiet. So Sandeep, just lastly, the 3 things that you mark or rather monitor when you wake up every morning, given the kind of turmoil that the globe is in right now. The VIX and what else?
global yields, not only US yield, all global yields for the developed market, including emerging market, even Chinese yields are important, 10 years, 30 years. Yields, currency and VIX. These are the two important things. We have already written the beginning of 2025. This year, you don't have to watch equity market, watch yields and currency market. You will get all answers.
I will give you one place, you'll get it anyways. Watch ET Now in the morning when you get it. We'll give you yields, we'll give you currency, we'll tell you US markets. So you don't have to look at phone or internet, just watch us, be with us, and you will get
We always do that.